Hello, Jim here. It's been a rough couple of weeks in the market. Again, today we had a rough day. I believe we might have hit new lows in the S&P 500. I think it either hit or came really close to correction level, which is a 10% correction. Where do we go from here? I can't really tell you. I would not be surprised if we go lower, but I also would not be surprised if we have a sudden recovery. So, one thing I wanted to talk about today is the fact that I'm running several wheel strategies, and they seem to have held up a lot better than the market in general. I'm going to share with you three different strategies that I use, and you can use them with small accounts like a $10,000 account or 25 or 50 to $75,000 account. I'll actually share with you the trades at the very end of the video, so be sure you stay until the end. And I'll also go over why these strategies might work well during this kind of a market. So stay tuned. I think it's going to be well worth your while. Okay, let's jump right in. I wanted to mention at the beginning that there is a silver lining to what's going on with the markets. The fact that we're in correction, I believe in all the indexes, maybe not the Dow, but I believe we are just today, the S&P 500. The NASDAQ, I think, is down 12 or 13%. And I believe the Russell 2000 may be pretty close to a bear market. The point that the markets are down so much, there are definitely some opportunities out there, some bargains. I'm doing some bargain hunting. I even had a call earlier today with one of my members who was looking at SoFi, and he wanted to spend quite a bit of cash to buy some more SoFi. He wanted to lower his cost on existing shares. I think he said he had something like 500 shares already of SoFi, and he was looking at buying another 500 and then lowering his cost basis. I believe his original cost basis was right around 18. And then right today, I believe SoFi is around 10 or $11. So buying another 500 could potentially, half his cost basis in SoFi and allow him to potentially sell covered calls at lower prices. So one thing I did encourage him to do is maybe dollar cost average into it. I don't know that we've hit the bottom. We may go to lower lows. So by dollar cost averaging, he doesn't necessarily buy 500 shares at once. He could buy 100 this week, 100 next week, and so on until he's gotten to that 500, which if we keep hitting new lows, then he'll be picking up future shares at a lower price. But if we do get a bounce and the market starts turning around, he could potentially, maybe he dollar cost averages for 3 weeks. He's bought 300, but he still wants to buy 200 more. And the market starts turning around, he could quickly buy that extra 200. So it's really hard to time the market, but by dollar cost averaging into it, especially when you're near lows, you could do really well long term. SoFi looks like it's going to be a really good company long term. They're possibly going to double their earnings. So if you're also going to hold the stock for a long time, it will benefit that way too. There's been a lot of studies about dollar cost averaging, and I think in most cases, people do better if they dollar cost average. So if you're looking to pick up some bargains, that is one suggestion, especially while we continue to hit these lower lows. And then I also wanted to mention that price does matter. So in a lot of my previous videos, I talked about how you can pay too much and you're putting yourself at risk. Just to give you, for instance, you buy maybe Palantir and it's currently 180 PE. That's really, really pricey. So at that point, you're buying future growth. So it might take Palantir 8 to 10 years to reach a level that, where it's worthwhile, meaning it's like a normal PE of 20 or 30. Now, the reverse can also be true. If a stock that typically has a 30 PE drops all the way down to a 15 or 20 PE and gets hammered because of this market, or they slightly miss earnings, and because of this market, they dive big time, it can also be a bargain, and it can be oversold. In long term, it will recover to what the true price should be or what that price should be. So I just wanted to mention that, even though what a lot of people do, especially if you're trading options, you're looking at your portfolio almost too much. I encourage you during this period maybe to back off a little bit. Don't look at your portfolio too much, unless you have a lot of positions that might be in trouble. But say you don't, the fact that we trade options causes us to be too in tune to it at times. If if you look back to when you first started your career, you rarely ever looked at your 401k, or your accounts where you might have invested. It was usually, maybe at the end of the week or maybe once a month. So just by trading options, we're on the market too much. We're looking at it too much. A lot of times, the market will recover fairly quickly. So you may look at it right now and it may look like you're 8 to 10% down for your in the markets or in your portfolio. But when the market does recover, it usually recovers very quickly. I think we're going to have a V-shaped recovery. And within maybe a week or two, we may get back to the point before the market started cratering and diving. And you don't want to be out of the market at that time. So, another important point is don't get completely out of the market. Stay in it. Long term, you'll do better. And corrections like this are fairly normal. So the fact that we haven't had one in 2 years, I do think we had one last year, I believe in July timeframe, but we haven't had a major correction in quite a while, and the market's gotten really pricey. So some of this is normal. So again, don't panic, be patient, deal with the trades you need to deal with. Remember the reason you sold puts on a stock, especially if you follow my guidelines and you really want to own it. Just remember why you sold those puts originally. And maybe you're picking up a great stock at a great price, even though it doesn't seem like it because it's dropped so much. So just wanted to share that. Now, I've been running 3-wheel strategies. I call them my 10K conservative wheel, which is like if you had a $10,000 account, you could potentially trade, a couple of stocks, maybe one or two. I've traded 2, and it's worked out pretty well. In that one, in my 10K wheel, I have not had anything get assigned to me. You typically, with that small of an account, and if you're starting from scratch, you're probably just doing cash secured puts or covered calls. So you're going to be, running the wheel, meaning you're going to sell a cash secured put. If it gets assigned to you, then you'll sell a covered call. And for a small account, you need to stick with inexpensive stocks. So the stocks I look at, I think one is $15, the other one is $28. Neither one have been assigned to me yet. I've just recently rolled them both and again earned fairly good income. And just a few trades can have a major impact. So a $10,000 account, a few trades, 2 trades each month, 2 or 3 months, you'll do better than you typically could do if you had just invested that account. And that's what I'll show you at the end of this video. So even for people with small accounts that want to get started, I think it's a great way to do it. Now, when I go over the spreadsheet itself, I'll go into a little more detail. I also have some notes that I share. Then I have what I call my balanced wheel. It's a little bit bigger. If you have a $25,000 account, it's primarily cash secured puts, but it can be potentially bigger companies and maybe more companies. In this account, I've been doing 4 or 5 cash secured puts on a monthly basis and rolling them if they get assigned to me. I then will sell a covered call. I have had one stock that was assigned to me and then it was assigned away. It was Pinterest. I personally didn't want to keep Pinterest because I don't use it. I don't use Pinterest. I don't understand it completely compared to some of the other social networks. But it's a little bigger, and the fact that it's a bit of a bigger account, but it works a lot like the smaller conservative wheel. The returns are a little bit better, or not necessarily a little bit better. They can be a lot better than the conservative wheel, but at some point the conservative wheel will get bigger and then it can become the balanced wheel. Now the advanced wheel, which can be accounts that are bigger, like 50, 75,000, the reason I call it the advanced wheel, it's one that you can be running spreads in. You have a higher access where you can do spreads. You might have margin, not the type of margin where you're having to pay interest unless you overcommit yourself. But the margin where the long puts or long calls, they give you credit for, meaning your required capital can be a lot less for a spread compared to just a cash secured put. And then also you're going to be potentially dealing with more expensive stocks and at times maybe riskier stocks. So in this account, I've actually had some two different stocks assigned to me. I had Zoom assigned to me and also had AMD. So I'm going to share with you a little bit about those two stocks, why I really like both of them for different reasons. And I'll go into a little bit more detail. I think AMD can potentially be a huge stock down the road, and I'll go into a little bit more depth at the end of the video. I also have another wheel trade that I did earlier. I did a video on it probably 4 or 5 months ago. It's what I called my guarded wheel strategy. And with it, if the markets get low enough and there are enough bargains out there, one thing you can do, and that's what this wheel strategy emphasizes, you buy 100 shares, you sell a covered call, and you sell a vertical put credit spread. And then if they get assigned to you, again, because it's a bargain and you can afford it, you can continue to do that. So say the vertical put credit spread gets assigned to you, you could sell the long put, you could sell then another covered call or two covered calls because you already own 100 shares, and it can work out really well. I may put a link for that video in the description if you're curious about it. But again, as we get, if the market keeps going down and we get into a true bear market, it would be a great opportunity to use this type of a wheel. And I may do another future video on that, especially if I start doing that. Currently, I'm not doing that. I did it with Google, but I may look at doing it again depending on where the market goes. So next, I'm going to jump into what I call my wheel trades workbook. This is what I share with my membership. I usually share it on a weekly basis, or after these videos, I'll post this video to my community in a couple of days, and I'll also link this spreadsheet, the most updated version of it. So let's jump into the next part, and I'll go into a little bit more detail about each of these strategies. Okay, now I've opened up my option wheel strategy spreadsheet. I've got it all in one place just for simplicity's sake. The first tab is my 10K conservative wheel strategy. And the reason I'm calling it conservative is, again, because you've got a small account, you can't do a ton of trades. So here you can see I'm assuming starting capital of 10,000. And then in January, I did 2 trades. Both have been closed. I did one on HIMS and one on Fiverr. They were both successful. I did roll Fiverr. And then HIMS, I just closed. It shot through the roof, went way up. I believe it went up to as high as like $50 or $60. Now it's come down recently. I think it's in the low 30s. So it dropped significantly. So it may be a good opportunity to do more trades on them in the not so distant future. So I rolled Fiverr, brought in some pretty good income. I had 2 contracts of each. So the first time I made 182, 179. These are like a yearly return of 118 and 27. Now the yearly returns are typically smaller because, again, you're dealing with cash secured puts. So you're not limiting the required capital to the spread, like to a spread value. So typically, it's going to be lower yearly ROIs, but still 118 is kind of crazy. And then 27 is also good. Now, when I rolled Fiverr, I just kept the same strikes. I was hoping it would get assigned away from me. It never did. I rolled it out to 321, brought in another 175, very close to what I did the first month in January. I did 178.66. In February, I rolled it and brought in 174.34. That includes closing the existing positions. That's why I'm showing these as closed. And here you can see required capital of 54.24. I probably could have lowered that because I didn't take this 178 into consideration. But it was almost like a 39 yearly return, primarily because it was for 30 days. So I made the trade on 2/5 and it was expiring on 3/21, but I rolled it before before 321. Of course, it's not even 321, it's only 313. Then Ken's is a new trade I did. It's another company I do like. Let's take a look at it because I do want people to understand what they would be getting into. So let's open that up. Let's do Seeking Alpha. Because it's a small company, so it is risky just because it's a small company. Here's Ken's. I believe it's only a couple hundred million. They did have good return or earnings back, and they have earnings today. So I don't know what it's going to look like. Hopefully they continue to do well. But if they miss earnings, they could dive big time. But the fact that 13.75, they're not pricey, and the premiums aren't that bad. If we look at right now it's a PE of 9. So if we look at valuation, it's not overvalued. Growth, it's got B growth, so it looks like it's growing revenue almost 20% a year. Profitability, it's got fairly good profitability. Now, if we look at earnings, looks like they only, no, they have more than 1 year. So 145. This year, 180. Next year, $2. So they're even growing earnings pretty well. Now the issue is over here. If you look at their income statement, they're only making around 120 million. So it's a small company, and just the nature of it being, or the fact that it's a small company, it's definitely risky. But I thought at $15, and then one thing I forgot to mention is we look at options. They have pretty good options. Not a ton, but it's usually right around this 15. So if it gets assigned to me, I'll sell a covered call at 15, and then another cash secured put at 15. It keeps it relatively simple. So now if we go back into the spreadsheet, here's Fiverr. This is the one I rolled over here. I brought in 121, so not as much, but of course we're going through the correction currently. I believe 226 or 25 was definitely before we got into correction territory. So 121 is not bad. And I believe Fiverr is like $26. I really like Fiverr too. I use them quite a bit for all my graphics. I used to use Upwork, but now I go to Fiverr. I can find, all sorts of people who can help me with logos, with images, with voiceovers. If you've never tried them, I'd give them a try. It's really surprising. Plus, if you have a specialty or something you're really good at, you might look at selling your wares on there. I a lot of times will look for local people or people in the U.S. that I could potentially give those projects to. And I always give a fairly good tip because I feel like that's important. So this time when I roll Fiverr, it's like a 22% yearly return based on the 54.78, which isn't bad. So I definitely will probably have one more trade. I may let this get assigned, this Ken's get assigned, and I'll sell a covered call. Probably maybe 324, 325, something like that, depending on what's going on with the market too. But just for these 3 months, I brought in 949. Then interest for the 3 months, I'm assuming you're at Fidelity and you're earning 4%. And that's even on cash that you're using for cash secured puts. So a total of 1,053. If I divide that into 3 months, the monthly average is 350, almost 351. But here you can see 1,052 for a $10,000 account. That's like a 10% return. And I've only done 2 months of trading and one trade in the third month. So you can see the potential. If I do this every month, I could potentially bring in a significant amount of money. The monthly ROI is 3.51%. And then yearly it's 42. So if you look at the rule of 72, which you just take 72 and divide it by the interest rate or the return, which is the 42.12, I could double this account in almost, or less than 2 years, 1.71 years. Now, some of the notes, these are, some of the stuff I've talked about in previous videos, I do try to do a 20 delta for the calls, especially, I want to, I don't want to sell the calls with too much, too high a delta because they could get called away too quickly. I do want to earn a little bit on the call side as well. And I found with a lot of these, the call premium is even better. So, and then going, I've rolled fiver a number of times. And I'm also talking about, doing multiple trades during the same month, for example. But I've not been able to do that here. Could also be because we're going through a correction. We have one or two corrections every year, typically on a yearly basis. The last one I believe we had might have been July of last year. If that wasn't a true correction, then you're looking all the way back to 2022. So what we're going through right now is a little bit unique. But that's why I say this is kind of surprising that I'm still doing well with this wheel with this small account. Again, stocks are holding up well with the correction and still amazing return with only one trade this month. So that's if you have a really small account, but you can also do any of these trades, in a much bigger account. You could, in a way, do any of these trades in bigger accounts. So this is just primarily if you have a very small account and you're just getting started, you probably can't do spreads. Plus, I encourage people to really understand what they're doing, start selling cash secured puts and covered calls and get used to that before you start messing with some of the more complex strategies. So next is my monthly wheel strategy. And I've been doing this almost 6 months now. I did it in January. Everything closed. This is back when the stocks were shooting through the roof. So all of these, Chewy expired, Square expired. They all brought in fairly good premium. Twillo, same thing. I think I closed it. Well, I rolled it, then I closed it the next time because it just shot through the roof. If I believe at that time, I thought it was just too pricey, but all of these had fairly good returns and brought in fairly good premium. Then I did have Pinterest get assigned to me. And I do, that's showing the impact on cash. So I'm showing at the end because I did have the shares get assigned away from me. So it's all calculated. And this is how much I made with each of the trades. So the first month I started with 25 and it ended with 22,656, but I did have some Pinterest shares, I believe 100 Pinterest shares. Then the next month I also did Pinterest. I did some covered calls. And then I also did HIMS, Bluebird, FCX. I really like Bluebird. It's also beaten down quite a bit right now. It's not a bad buy. FCX is a mineral company. They do mining of different minerals. I do like them. And they've been, I think they're at 38 today, or they were earlier. They may be down now that the markets are really diving. And in Fiverr, I was able to let this one expire and again brought in some good premium. So at the end of the month, I was at 23,568. And then December, same scenario, roll and was able to roll and close and expire. Brought in some pretty good income, a total of 1243. So at that point, I was 24,811. And again, I had 100 shares of Pinterest. Now, Pinterest missed earnings. They dove quite a bit. So it was kind of hard to sell covered calls. Once I was able to, I went ahead and did. So Pins, here's the covered call. And that should be closed too because it got called away from me the next month. So that should be blue. But I made 102 on the covered call. And these are all the different returns. So again, these are all cash secured puts. So they're lower than some of the other returns I share in my videos, but still good returns. I ended the month with 25,747. So again, made close to 936. So at that point, I came to February when we started kind of going south. But PayPal, I did open a PayPal at 77.50. Now I believe it's fairly deep in the money. I believe it's low 70s. I only did one contract. I'll probably look at rolling them. I did it for 321, brought in 223. Bluebird, it's been in the money quite a bit. It's funny. I believe it's like 33, 34. It got back up to pretty close to 40. And I've wanted it to get called away so I could sell a covered call, and it just doesn't seem to. So I did roll it out to 417, brought in 217. And both of these had some pretty good yearly returns, 24 and 18%. Then FCX, I rolled it again just today. That's what you see here, FCX. So these two are still opened, and I also got assigned with pins. So I got assigned at 34. So over here, I added back in the 3,400, and and using that as capital to be able to make more trades. So now I'm at 29,709. Started with a $25,000 account 4 months or 5 months later. I'm at 29,709. And then again, I rolled FCX. So I only have one trade in March. I'll probably have more. So this will be a little bit higher when it's all said and done once March is over. But when I rolled, I brought in 123, which is like a 16% return. And at this point, I'm at 30 with all the interest, and then I'm at 30,378, and we can see the details over here. So that includes the premium and also the interest I earned. The interest may be a little bit high. I've got it at, I believe I have it at 4.01 or 4.15, which I think it's 4.09. So that may be a little bit high. And then total income 5378, and I believe that should match this 5378. So you add 25,000 and then 5,378. That's how you come up with 30, and that's just as a regular return is like 22%. Monthly income, if we break it up for 6 months, which again March would have probably 2 or 3 more trades, so this would probably be closer to 1,000. Yearly income, if you did this and continued to do it the way I've been doing it, you would make pretty close to almost 11,000 for the year on a $25,000 account, which is like a monthly return or ROI of 3.58, a yearly return of 43%, and you could double it in 1.67 years. So, and I believe when I last video I did, it was a little higher than that. It's also partially because Bluebird and FCX, if FCX hadn't gone down so much, I probably would have brought in more income with it. But both Bluebird and FCX are in the money, still are in the money. So, who knows? Maybe later in March, both of those will be assigned, and I can also do a covered call. And then the spread wheel trade, it's been a little bit crazier because I probably did too much on the chip makers, and everything went really well. I closed, rolled, and closed and made good income back in November, December. I started at Micron, Lam Research, Qualcomm, Micron. Then I added 4, and everything tended to work out really well. Even AMD. AMD was, I believe, out of the money at 125, but then when the market started tanking, and AMD actually was one of the first stocks to start tanking, then things got a little bit trickier. I was still able in January to close most of the positions, and I made some pretty good income. Here you can see the different returns, and it's higher because it spreads. And also I'm going for shorter periods of time, so potentially you can make a lot more income. And then this was in February. This is when the market started to really head down. So I started doing a vertical put credit spread in Zoom. I did that with 3 contracts at 77. In this account, it was 77 was the short and 71 was the long. And then I brought in some pretty good income, 290. And it's very high because it was the DTEs was, I did it in 127, and yeah, the expiration was 27, so it was, I think, 10 or 12 days. Then I was able to roll it. I rolled it up because Zoom kind of shot up. So I did roll it up and then roll it back down. And then when it got assigned to me, I ended up selling the long put, which got me in a pretty good position with it. CSP, cash secured put roll. So I also, at the time, I converted. At one point, I was doing 135, 125 with AMD. I think that's AMD. Yeah, I was doing 135, 125. I converted AMD into a cash secured put. So that's why this is showing is a CSP, cash secured put roll from, should have in there from a vertical put credit spread. And I made 340, 320. And it was a low return, 9%, but I was trying to lower the strike. And then Mara, I did an iron condor, a Mara. The call side, actually, it expired. It shot through the roof. I know it didn't shoot through the roof. It dropped quite a bit. I believe Mara is right around 12 or 13 currently. So it was made 172 with it. It worked out pretty well. I converted it to a vertical put credit spread. So you'll see down below. It's now a vertical put credit spread, and I just recently rolled it. Was able to roll it out to 4.4. Then 4, it's also pretty deep in the money. It'll probably get assigned to me with this big drop. That it also, I believe it's maybe like 82 or 83. And I've been trying to roll it. I have not been able to roll it. So, and then I also had this as Zoom when it got assigned to me. So I did some calculations and figured out my cost basis. And I was down about $36 at the time. Now, again, I don't know what happened today, but I like to at least put something in there related to, how I ended up. At first it was 500, but by the time I was working on this spreadsheet, it had gone up. So a little bit of a loss, maybe a bigger loss now. I believe Zoom is, my cost basis is right around 72. And I think I talk about this, less due to assignment or loss due to assignment, then a new cost basis of 73.58. I started selling covered calls on it. And the covered calls have worked out really well. Brought in 375 with covered calls. Cost basis 73.56. Sold another covered call, or rolled it actually, kept the same one, rolled it at 77. Brought in another 247, which was like a 17% return, and brought the cost basis to 72.73. So it may not be out of the money currently. And then Amara, I rolled just yesterday. I had to widen the spread a little bit. It was 16.12. I rolled it 16.10, brought in a little bit more premium, $97 in premium. At the time, it was 13.16. And it ties in with Bitcoin. If Bitcoin does well, it'll do well, but Bitcoin hasn't done well lately. And then, so if I calculate all of this, I've made $35.95 in this account. And I didn't show the beginning and ending balance, but we can look at details down here. So total option income, $36.95. Now, if AMD comes back, so my cost basis was 119 something, and then I was assigned at 125. So that's why I'm showing that 3,800 loss. It's 19 times 200. Now, if AMD, which I expect AMD to come back, potentially, I think they may be $150 stock by the end of the year. So in that case, this would be kind of null. Let me share with you why I think that. And I mean, they're coming out. The word is that their next group of chips are so good from what the industry has seen that a lot of people took their time with making orders, that they didn't want to order the existing chip. They wanted to wait till they've I think said that they will be releasing I think it's the 350 chip will be coming out this summer. So a lot of companies decided to wait. So when that comes out, they're probably going to beat earnings even more. But if you look at earnings, they missed the gap, but they actually had better revenues and they were in line. But if you look at this, you can see 52%, 40%, 36, and 31. And if you go out and you look at this estimated earnings, they're going to do 470 this year, 633 next year, 765, almost $10, then almost $11. So, and some people are saying this is potentially, it could be higher than that because they're saying that their new chip will compete fairly nicely with NVIDIA, and that they have another whole group of chips that are probably work well with a lot of the manufacturing that's coming back to the States. They're specialized chips that they can program to work with different types of robotics and different types of needs, and might be a huge need if we're start building a lot of manufacturing plants in the US. So they could do really well. Now they've been just hitting lower lows. I mean, it's kind of crazy if you look at their max. I mean, they shot all the way up into the 200s. Now they've come all the way down. I'm expecting them to shoot back up. And that's why I'm thinking if they shoot back up, it may be 150. Now I could be completely wrong, and they keep coming down and they end up being a $30 or $40 stock. I don't think so. And I'm beginning to see more and more analysts and more YouTubers talk positively about them. So without that 3,800 loss, it would be, this total option income would be a lot higher. Total interest, but we're still talking about on a monthly basis, 945. And since I think I did it for 1, 2, 3, 4, 5, yeah, and it's five months. So this is average for 5 months. That's still a yearly income, 11,343. And then here was the 65,000 in capital. And then this would be like a 25% yearly return, even with going through a correction, because at the same time, Zoom got assigned to me. And Zoom's another one. It could be back in the mid to high 70s or even low 80s pretty quickly. I also think they may be a takeover target. I like Zoom because they have so much cash. They're a cash generating machine. They have nearly $8 billion in cash, and I think they generate a significant amount every year with, quite a bit of cash flow. I could see someone buying them just to get their hands on that cash. But if you look, so for a monthly ROI, required capital 2%. So you're talking 25% on a yearly basis, but that's still really good. I mean, I don't think the S&P 500, it was that high over the last 2 years. Rule of 72, 2.87. So just shy of every 3 years, you could double this account. Now, if you look at total assignment or the total value of the account, it's a little lower, which 1.45 or just shy of 18%. And it would take you closer to 4 years or more than 4 years to double the account. And this is all the accounts added together. So it would bring in 2894, which is like a 3.6 required capital return monthly. If it's total assigned capital, meaning the whole value of the account, you're using this 100,000 versus the 80,000. It's still a really good return. It's still, it's still doubling within probably 3 years. This is actually 3.61 times 12. This is the total. So this is required capital base. That's what the yearly return would look like. This is the yearly return for total assigned, based on this 100,000. So all of these together, you're still doing really well. You're doing a little bit better. And again, if you just did these two, you wouldn't have the AMD big loss here and the small loss for Zoom. But like I said, I think Zoom actually is working out pretty well. I may roll with a covered call again before too long. So that's what I'm doing. That's what I'm sharing with my memberships. If you're curious about my membership, details will be in the description. I encourage you to take a look and, also add a comment or leave a comment. I'm curious, are you doing something like this too? What kind of trades are you doing? Are you trading some of these same companies? Or do you have a suggestion on another company that might work out really well? And I just wanted to thank you for taking the time to watch the video, especially if you stayed this long. And as always, I look forward to seeing you next time.